Something caught my attention this week, and it explains why auto insurance is suddenly becoming one of the most painful bills in America. Not because you bought a new car, not because you got into an accident, and not because anything in your life actually changed, but because the entire systems around you is shifting quietly and fast. People with perfect driving records, same car, same miles, same routine, are opening their renewal notice and seeing premiums jump $300, $600, sometimes over $1,000 a year. And the part that stopped me wasn't the size of the bill. It was what's actually causing it. So let me walk you through what's happening behind the scenes. Who's getting hit the hardest? And why gig workers are sounding the alarm? And what this means for millions of Americans heading what's left of 2025 and beginning of next year. Across the country, drivers are seeing increases they had never experienced before. Additional 18% in Ohio, 25% in Georgia, 30% in California, 35% in Florida, 40% in parts of Texas. And these aren't reckless drivers or luxury cars. These are normal households, same vehicles, same driver records, same everything. But now, paying hundreds more every 6 months? For many families, our insurance has become the new rent increase. A bill you cannot skip, cancel, or negotiate away. This crisis didn't appear out of nowhere. It's the result of 7 major pressure points colliding all at once. Number 1, cars are far more expensive to repair. Modern vehicles are loaded with sensors, cameras, ADAS systems. A simple bumpy fix that used to cost $500 now runs $2,500 to $5,000. Number 2, parts are pricier and never went back down. Supply chains healed, but prices did not. Number 3, repair labor is more expensive. Shops raise rates because wages, equipment, and rent have all climbed sharply. Number 4, accidents are more severe. More speeding, more distractions, more total loss claims. Number 5, weather disasters are taking a toll. Hurricanes, hailstorms, floods, billions of claims that insurance now need to recover. Number 6, fraud is surging in certain states. Stage accidents, inflated injury claims, organized rings, and everyone ends up paying for it. Number 7, insurance have been losing money for years. Many companies paid out more than they earn. Now they're correcting it aggressively. This is why premiums are exploding and why relief won't happen overnight. Some states are seeing exceptional pressure. Florida, fraud, severe weather, and the home insurance collapse. California, pause policies and slow regulatory approvals. Texas, weather losses, higher repair costs. Georgia and Nevada, among the biggest 2024-2025 spikes. Michigan, still one of the most expensive states in the country. Drivers in these states aren't just surprised. They're frustrated and overwhelmed. For low-income drivers, driving isn't optional. It's how people get to work, schools, medical appointments. Now premiums are eating into grocery money and basic bills. Middle-income families. This group is already stretched by rent, groceries, utilities, and debt. An extra $60 to $120 a month in insurance is a serious hit. Older drivers, fixed incomes, fast rising premiums. Math that simply doesn't work. For young drivers, rates were already high, not extreme. Some young adults are paying more for insurance than their car payment. There's one group facing even bigger pressure than everyone else. The gig drivers. Uber, Lyft, DoorDash, Instacart, Amazon Flex, Grubhub. For them, rising premiums aren't just an expense. They're the threat to their livelihood. Here's why gig workers are feeling the worst of this spike. Commercial or rideshare coverage is more expensive endorsements, and upgrades now cost far more. And those increases are rising faster than regular policies. Higher mileage, higher premiums. 20,000 to 60,000 miles a year takes a toll. And insurance price, the risk is heavily. More wear, more claims, windshields, tires, bumps, fender benders. When you're on the road nonstop, incidents pile up. Some insurers are dropping gig drivers entirely, refusing renewals if a vehicle is used for rideshare or deliveries. Earnings aren't keeping up. Delivery and rideshare platforms have cut per mile pay, promos, and bonuses. Many are considering quitting if gig drivers walk away. The wait times go up, delivery fees rise, and the entire convenience economics slows down. Insurance companies are tightening their policies across the board, pausing new policy applications, raising deductibles, lowering coverage limits, adjusting risk pricing by zip code, adding new administrative fees, pull out of expensive states entirely. This isn't a normal rate cycle. It's a structural reset. Here's the road ahead as we move deeper in 2025. More rate increases may be approved. Some insurers are already filed for end of the year hikes. Companies may continue withdrawing from coastal or high-risk states. High deductibles becoming the new standard. $1,000 to $2,000 deductible may become the minimum. Potentially, regulatory intervention states are debating fraud reforms and catastrophic loss changes. Drivers will begin switching insurers yearly. Shopping around might become the only way to survive increases. Auto insurance used to be one of those bills you barely thought about. Now it's becoming one of the most painful hits to the American wallet and one of the hardest to escape. You can trim streaming services, you can cook at home, you can delay buying a phone or a laptop, but you cannot stop driving. And that's why this crisis is growing, especially as we close out 2025 and head into the new year. So stay tuned, because the next round of pricing approvals will reveal just how big this problem is going to get. Thank you for watching.